Welcome to Author's Note and the FT. I'm Martin Sandbu, the FT's economics leader writer. The recovery is just not arriving. The UK economy has kept struggling over the last year, and at the same time, corporates, businesses are flush with cash that they just don't want to spend. With me today to explain why is Andrew Smithers. Welcome, Andrew.
Thank you very much.
What's happening here, I think, is, in your view, a change in both cyclical and structural behavior in the corporate sector vis-à-vis the fiscal sector. If we can get the first chart up. This is a chart of the public sector deficit, or the public sector balance, and the corporate sector balance. And we see how they usually track each other. Of course, the difference here is the net exports, foreign sector, and the household sector. Now, you have pointed out in your work that something very interesting is going on here, a sort of secular shift. Could you explain that?
Yes. Not only do corporate cash flow and government deficits go up and down together on a cyclical basis, they're also showing a large secular trend. As you can see, both of them move up from the left hand to the right hand, as well as going up and down together.
Right.
What you've got here is a structural as well as a cyclical change.
Now, the cyclical part is quite reasonable that they go together, because when one sector's deficit goes up, another sector's surplus has to go up, almost by definition. What does the structural change mean?
The structural change, in my view, represents a change in corporate behavior. What you've got here is a tendency over time for companies to push up their profit margins more than they would normally have done in recessions, and to invest even less than they normally would have done in recessions.
So let's look at the investment behavior in our next chart. Now, this chart traces out UK business investment as a share of GDP. That's the red line here that goes up and down, of course, cyclically as usual, with this left-hand axis. And the output gap, i.e. the difference between actual economic output in the whole economy versus the trend, what you would expect if you're on trend. And that's the blue line that also goes up and down. Now, it seems here we're seeing something of the same as you described in the previous chart. In normal times, these move in opposite directions to offset each other. But something's happening in the last decade. Could you talk about that?
Yes. As you say, when companies wish to save a lot of money, they have, in Keynesian terms, an ex-ante saving surplus. Then, in order to avoid a severe recession, the standard Keynesian answer is to run a large fiscal deficit.
Right.
But the problem here, and this is the key to the whole discussion now about why we shouldn't stimulate our economy anymore by further fiscal means, is because what we're looking at here is not a cyclical change, but a structural one. And this is vital for UK economic policy.
And that structural change is this complete drop-off in investment in the last 9-10 years, is that right?
Exactly. You see, not only does investment go up and down with the cycle, but it's falling on a trend basis. Companies are investing less and less, and as I said, they are also pushing up margins relative to the state of the economy, not just on a cyclical basis.
And we're finding, of course, at the very end here that rather than shooting up the way we'd expect from previous cycles, investment is just staying very low. Why is this?
I think it's because if you change the way people are paid, you will change the way they behave.
So what's happened?
And in the last decade or more, we've had a dramatic change in the way business is paid. One piece of statistic which amuses me, because it's so sad, is that bonuses and things like that in America have moved from most of the money businesses get for management comes from their salaries, and now it's only about 16%. So people are motivated by short-term considerations. The result is, of course, that you get them behaving in a short-term manner, and therefore they want to take as much money as possible in the short run and invest as little.
So here it sounds like the issue of mega bonuses is not just an issue of fairness, of political outrage. It might well be something that is making the recovery much harder to put in place.
It is the key problem for the US and the UK in generating a recovery. I'm not the only person that says this. There has recently been a rather theoretical but very good paper published by the Federal Reserve Bank in New York saying just the same thing.
Something to ponder for shareholders. Thank you very much for watching Author's Note.